This year is different than any other election year that we've had in the past. So preparing for the mental load that we'll all likely feel this year, especially when it comes to our investments, is super important. I know I don't normally post videos outside of Saturdays, but I feel so strongly about this message, and I wanted to release this as soon as possible to prevent, even if it's just one of you, from making a grave financial mistake this year. And I'll tell you what I mean in a little bit. We all need to understand and do 4 things related to our retirement plan and our investments. And by doing these 4 things, we're going to feel more prepared, calmer, and just more confident in our financial plans, and be ready to take on whatever this year brings. For those of you who don't know me yet, I'm Julia, Certified Financial Planner and Managing Director of URS Advisory. I've spent the last decade of my life studying finance, and I also manage millions of dollars for our clients who are approaching, newly, and in retirement. So let's jump into it. The first thing we all need to do is to understand what to expect during an election year, and that is higher than normal market volatility. Markets are volatile every single year at different times, but during an election year, the already dramatic and nerve-wracking news cycle gets even more dramatic and nerve-wracking. Logically, we all know that markets don't go up in a straight line and that volatility is normal, but during these volatile periods, we are all subject to getting emotional, and most dangerously, making an emotional financial decision. If we remind ourselves of this, we can calm our minds somewhat and prepare ourselves for erratic market moves in advance. Our mental capacity is just as important as our physical capacity. And I love this quote by J. Donald Walters. He says, "You will find peace not by trying to escape your problems, but by confronting them courageously." What this means to me is that you can't find peace or calmness without confronting and accepting your risks. This is why awareness is so important, and I'll keep touching on how we can remain more aware throughout the video. The news cycle today is all about driving fear. Even the most innocent stories become sensationalized, and this affects our mental well-being. Why? Because ultimately, fear sells. And speaking of fear selling, what makes this election year different is the introduction of artificial intelligence into the already nutty news cycle. Deep fake videos have the potential to sway people's votes, and the technology is getting advanced so quickly. So when you see videos come out in the news, have a healthy dose of skepticism. Don't believe anything that you see right away. And we shouldn't do that anyway, right? But now it's so hard to distinguish between truth and fallacy. But we just cannot afford to let the news cycle scare us into making emotional decisions. In fact, I've seen this happen in the worst way. I remember years ago after an election, a close family friend sold their entire 401k to cash because they just knew that the stock market was going down and that things were going to be terrible for America. He asked if we were making any adjustments for our clients, and I explained that our clients are always prepared for bad markets. In that moment, I felt horrible that I could not somehow stop or reverse his decision, and over the following 4 years, the market took off like a rocket. So that emotional decision cost him dearly and prevented him from retiring sooner. So if you're feeling nervous or fearful, please speak with your financial advisor before making any major investment decisions. In our practice, our clients know that we understand that what's in the news or who wins the election is not correlated with how the stock market moves. We've seen this over and over again. In 2020, during one of the worst economies in history, we saw the market take off. I'll never forget seeing this image on TV. It's Jim Cramer in March of 2020 when more than 16 million Americans lost their job that month. And yet the stock market had its best week since 1938. Just last year, right after the banking crisis in March, markets also took off. And these are just 2 examples, folks. So what do we need to do to prepare ourselves for anything? Well, first, you need to take a look at your current investment allocation. If you have an advisor, make sure that you review how you're allocated and what you stand to lose. In our practice, we use software to illustrate how our portfolios react in good markets and bad markets. And then we stress test our client's financial plan against poor outcomes. Okay, so if you don't have an advisor, check out Portfolio Visualizer on portfoliovisualizer.com. If you click Tools and scroll down to Backtest Portfolio, you can type in your current holdings and measure how they performed all the way back to 1985. This gives you an idea of the worst case scenario. Of course, we could always be facing an even worse financial crisis, but using 2007 to 2009, where the S&P 500 lost over 50% of its value, is a pretty good metric for a worst case scenario. Oh, and by the way, this tool is completely free to use. Secondly, take stock of your portfolio buckets. By the way, if you haven't watched our bucketing video, please do so right after this, as it outlines how we bulletproof our clients' retirement, and I'll put a link to it below. Okay, so our clients have 3 buckets. A green bucket or a fixed bucket where the assets do not fluctuate with the stock market, and this money is used to fund the next 3 to 5 years, so that they're not relying on the stock market for their immediate income needs. The yellow bucket, which is the balance bucket, is made up of both fixed and growth assets being stock. This money funds years 5 through 15 of retirement. And then the red bucket, or the aggressive bucket, is basically all stock. You can add in metals or other alternative assets if you'd like. And we don't touch this bucket for at least 15 years. So we don't need to worry about the temporary fluctuations, and we're able to give the market time to appreciate over the long term as it always has. Now, I want to take a moment to warn you about a particular fixed asset that hasn't been acting like a fixed asset lately due to rising interest rates, and that is bond funds. A lot of folks get caught off guard, especially in years like 2022. So let's take a look at the low-cost, highly used bond fund, ticker symbol BND, which is Vanguard's total bond fund. We can see that in 2022, the fund lost over 13%, where stocks lost roughly 19%. So that year, a diversified portfolio really had nowhere to hide. This is what happens with bond funds, though, because unlike individual bonds, these bond ETFs or mutual funds never actually mature, so your investment is much riskier. When rates rise like they have been, the value of the underlying bond funds in the fund lose value. So to the contrary, when you buy an individual bond, as long as you hold to maturity, barring any major default, you'll get your principal back, so the fluctuations in rates don't affect your ability to get your 100 cents on the dollar back at maturity. In our clients' green and yellow buckets, we've been using a combination of individual bonds in lieu of bond funds until the Federal Reserve actually starts to reduce interest rates. So they've paused, but they're not there yet. If you're not working with a like-minded advisor, make sure that you understand the risk around bond funds and how they can affect the safety of your fixed assets. And if you have questions or are thinking about hiring a retirement planner or a team, feel free to reach out to us. One more point before we move on. Inevitably, during bull markets, we can start to get frustrated with our fixed assets. It's just human nature, right? If stocks are earning 10% on average and our fixed assets are only earning 4%, we can start to feel that FOMO and want to invest more of the green and yellow buckets into stocks or into the red bucket, okay? But this goes against the principle of bucketing your money. We need to remember that our fixed assets are what actually allows us to hold the stocks that we own through periods of volatility and protects us from the sequence of returns risk, which, if you watch our bucketing video I referenced earlier, will show you how pulling income from a losing account, where we're forced to recognize the loss because we need income, obviously during a down market, can cause us to run out of money in our 80s or 90s. It's hard to remember this during bull markets, but that peace of mind that we were discussing earlier is equally as important during bull markets as it is during bear markets. Oh, by the way, if you're finding this video helpful, please subscribe. You can click the button and then click the bell so that you're automatically notified of our future videos. Okay, so in summary, understand how you're invested and make sure that your fixed assets are actually fixed. And if you don't have an advisor who's already rebalancing for you, consider rebalancing if you're really out of whack. This way you can be proactive instead of reactive. All right, let's review how the market typically performs during election years. Some of the major questions we get are: 1, what happens if it's a Republican or a Democrat? And 2, what about if Congress is gridlocked? Well, let's take a look at this chart of the S&P 500 that dates all the way back to 1930. The red blocks are Republican presidents, and the blue blocks are Democrat presidents, and the yellow line is the S&P 500. So what do you guys notice? You'll see that the market trends up regardless of who is in office or how Congress is set up. In fact, since 1928, the average return during an election year is 11.28%. And 19 of the past 23 years, or 83%, have been positive. So even though there is always volatility during the year, the returns on election years are overwhelmingly positive. Now, for those of you who are thinking, well, this time it's different, I can sympathize with that, as the world does seem to be getting crazier and crazier, but I urge you to reconsider your position and remember that there were always people who thought that it was different this time, or worse, right? Every single election since the market opened. Now, if you'll allow me to get more specific on the intra-year election pattern, you can see that if a sitting president is running, which is obviously our circumstance, you'll see the largest or biggest or highest returns in the second half of the year. More specifically, the first and third quarter produce the largest returns on average. This is very different from a typical year in the stock market, where the first and third quarter typically produce the lowest returns on average. At URS, we like to take advantage of down markets and turn these negative periods into opportunities by performing Roth conversions for our willing and able clients. This means that we're converting and paying tax on a lower dollar amount and then allowing it to grow tax-free from there. Typically, we're doing these conversions in March and October of every year, but this year, I have a feeling we'll be converting during different months since this election pattern is already tracking well. All right, folks, so let's summarize. The 4 things you need to do this year to stay grounded and focused on your plan are 1, prepare yourself for volatility and sensationalized news. 2, take stock of your investment allocation. And 3, if you're retired, make sure that your portfolio is bucketed and that you have enough fixed assets on hand to weather the next 3 to 5 years. And then lastly, remind yourself of historical stock market returns and the typical election year pattern. If this video was helpful, please subscribe to our channel and pass along to someone you care about. Thanks for watching, and I'll see you soon.